Good evening. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk about our stock market investment strategy utilizing closed-end funds. So, to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. And I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So the platform update is that I think I'm almost finished with the initial book, and I've got the outline for the closed-end fund book, and I have the outline for the scholarship book made. It's just finishing one and then moving to the next and moving to the next, and then figuring out the best way to launch all of this stuff together and to really try to centralize or at least try to streamline my process and help me organize a lot better. Um, the strategy session for the week is really boils down to one piece of advice. Don't fear the noise. As I prep these videos, I end up doing a ton of reading. I watch a lot of clips. I watch a lot of videos. And I saw several stories this week, but one in particular takes the cake, and it'll be at the very end. So to kind of splash our way through the other stuff, we've at this point, as of today, we've collected almost $215 billion in tariff money. That's pretty impressive. Um, the government shutdown rolls on, and it really boils down to Democrats pushing for $1.5 trillion in spending for illegal immigrants, and the Republican end of things puts that at a stalemate. President Trump has done uh, he's remade policy to carve out illegal immigrants out of uh, being benefactors of anything taxpayer related. And the Democrats have made it their mission to do anything to oppose Trump, and in that, to support illegals over American citizens. And now that's boiled down into the government shutdown, or that's kind of trickled its way into the government shutdown. And if you didn't think that was possible, House Democrat Whip, who's the second in command for the Democrats in the House, Catherine Clark, admitted that her party is using the shutdown as political leverage. In quotes, even if it means American families suffer in the process. So the Democrats are holding the government hostage essentially over funding for illegals, even if it hurts American citizens. And y'all know my politics. Uh, but as a political party, I just don't see how self-strangulation makes any sense. It really is political suicide at this point. But just like Sun Tzu says, don't stop your enemy from killing themselves. So we'll see what happens in the shutdown. We'll see what happens to both parties afterwards. But regardless of all the party politics, the economy and the market are chugging along pretty much unfazed. Now, I say pretty much unfazed because the gridlock is starting to impact the housing market. Fewer loans, fewer transactions. It doesn't sound like much until you realize housing makes up about 20% of the overall economy. And even if the economy starts to stutter, I still don't think the market itself is going to stutter. The market just chugs. It just goes. Uh, Crypto had a rough week, and there's a lot of noise about why. There's a lot of opinion about why. The short version seems to be that BlackRock, among other bigs, but BlackRock dumped its Bitcoin holdings, and that sent shockwaves through the market. And I don't like BlackRock, so I'm not going to give them a pass. But there were other bigs doing the same thing. Now, why? That gets into a lot of opinion, uh, a lot of opinion. And truth be told, no one really knows why. There's a lot of speculation, but not a lot of known info. Or maybe there's too much known info for somebody to really render down an issue or a single issue. So outside of crypto and more dollar talk, the Federal Reserve might step in with another quarter rate cut. And honestly, it's still too little too late at this point. Yes, the economy goes along. Yes, the market chugs along. Overall, consumer sentiment is high. Overall, inflation seems to be dropping off. The Federal Reserve should have cut rates by at least 1% almost 6 months ago. So we're still operating, I don't know, well behind the curve. A quarter percent, so a 0.5% total, yes, will make people happier, but is it really going to push us forward? I don't know. I don't think so. But the biggest story of the week goes to the herd, which begs the question, what's the herd panicking about this week? They didn't like the crypto sell off, but most of the herd barely understand crypto to begin with. Personally, I'm not a fan of direct crypto investing. There's too much I don't know. And I still think it'll play a role in the coming one world financial system. It's supposed to be very open source, but very uh, like blockchain itself is supposed to be extremely open source where anybody can go in and make sure no one's tampered with it. But crypto is now heavily regulated and it's not as free as it's sold to be. So if the herd didn't panic about crypto, what's spooking them? Well, the herd and their handlers are shouting about an AI bubble. Seriously. I mean, we're two steps up the up escalator, and they're already calling the AI world a bubble. And I'll admit, top AI and those tech darlings, yes, they're overpriced. It's true. But a bubble? Not yet. So, man, we talked about the herd a lot. The herd just don't think. They don't. But my advice is don't buy the panic, buy their fear. And in buying that fear, we have to discuss volatility or the ebbs and flows, like the up and downs of the market. And there's three ways to play volatility. We can follow the herd and panic sell. We can use the panic to buy, or we can use the panic to buy funds that thrive on volatility. So let's be clear. I don't speak like the herd means that I don't follow the herd, period. And when I say sometimes I walk alone, that means that the herd has their direction, then you have another group that has their direction, and I'm quite okay with being on my own. So, first and foremost, we don't follow the herd at all. Second, those volatility funds aren't what you're buying or shouldn't be what you're buying during volatility. You buy them before when the waters are calm and nobody's paying attention. When it's easygoing, the herd's pushing into greed. It's not smooth sailing, but it's a lot better than this choppiness we're dealing with right now. That's when you buy the funds that are focused on volatility. You get them cheap because they rise when everyone else panics. And third, the main strategy, we use fear to buy quality assets at better prices. So, yes, the herd's panicking week in and week out for any number of reasons. But fine, let them panic. We're not in the herd. We're not following the herd. We're aware of them, but we're not fazed by them because, quite honestly, you and I are rational and logical, and the herd is not. And to be quite honest, when the herd panics or when it doesn't panic, which they're kind of always panicked, But there's not much difference in the overall strategy between calm market and chaotic market, or smooth seas and choppy seas. Whether the crowd's greedy or fearful, our mission stays the same: buy income that grows and compounds over time. The only real adjustment is discipline. We tighten the standard, we demand yield. And if the market's going to throw us discounts, because it is, then we'll take them, but only when the yield makes sense. So please don't fear the noise, use it. Turn that volatility into opportunity. So what do we buy? Honestly, it's the same targets. I mean, until the Federal Reserve makes some drastic change, which quarter point, gosh, quarter percent rate cuts are not drastic change. Now, if we get 6 months in and they've cut a quarter percent every month, then that would drastically shift the market. But they've done so gradually. It's not like cutting a percent tomorrow. So until something drastic truly changes or happens, the target in the overall strategy stays the same: bonds and bonds proxies, end to end energy, which would lead us into end to end technology, right? So end to end energy, oil and natural gas, anything from production, like pumping, manufacturing, transmission of it, and end where it meets where supply meets demand. And then you also have tech in there because it takes oil to make technology. And we want technology beyond the big players. If we pile into only big players, if you're only piling into Amazon, Apple, Nvidia, Meta, Alphabet, IBM, right? The list goes on. If you're only piling into the big five, and there is some type of bubble, which I don't think we're going to see one for a while. When your portfolio, when your funds are weighed down by those, and there's a blip, you're going to feel it. But if we're looking beyond the large caps, if we're looking into small and mid-sized companies, one, we're not going to feel it as much. But two, those are the companies that are really thriving on technology and advancements because they're improving their overall efficiency and improving their bottom line. So, what does that look like for us? I mean, what does that look like for the week? So, let me share my screen again. There we go. So, the list breaks down like this, and I'm going to leave it grand scheme so that you can pause the video, you can see all the data, and I'm not really going to thin things out like normal. I will a little bit, but not quite like normal. So this is the list of every single triple target that made the cut for the week. My advice: pause the screen and read it. And what my goal is in building my platform, what my goal is between writing these books and then finding a hosting site, is to find a place where I can host this data and offer it. So I would, yes, demand the discount, but also demand the yield. So all of these are triple targets based on the existing discount meeting the metrics of being double the historical average and greater than the 5 year average, unless the company's a little newer. When in that case, I'm a little more flexible in keeping it on the list. Like BRW is reformed, right? It doesn't have a long history under BRW, but it's currently at 11% off, which is better than the 3 year average versus, see, NMAI is a 4 year old fund, currently at 9%. So it's better than the 1 year, but less than the 3 year, but it still made the list. So I would demand discount. Yes, that's why these things are on the list. We want to look at when they pay. I love monthly funds. It consistent, reliable, they pay every month, right? There are some exceptions to that. And so if you're looking for a volatility play, which I'm not, I will confess that I have not dug into volatility plays. This one comes recommended by somebody I read weekly. But the downside of that is It's a quarterly fund. It doesn't pay monthly. But if you're going to play the volatility fund or play the volatility game, then maybe this is on your radar. So of the three, USA makes the list. One, it's a great powerhouse blue chip fund. Two, we already own it. Three, based on its portfolio's history or based on the fund's history, it does seem to ebb and flow, which on my end of things makes it a great short-term hold, meaning I don't plan on keeping it indefinitely. But two, if you did plan on keeping it indefinitely, you can track its fund price to where you can buy it at you're not going to buy it at its absolute lowest, but you can track its value to where you can buy it lower and then keep it and then wait for it to drop back down and buy it lower again. Um, let's see. So outside of USA, we want to go to yield and we want to demand yield. And normally I would say unless there's a good reason for picking it up. And that kind of plays in, but not really. So if we're going to demand a 9% yield, then all of this goes away. Uh, there we go. All of that goes away. The only two funds I could suggest on keeping would be HFRO because it does have the largest discount. So it's like buying it for 56 cents a share instead of a dollar because it's 44% off. The price on my end of things, the price has gone up in the grand scheme of things, not a big deal. But the current price is about a dollar higher than my existing buy-in price, and they haven't raised the yield. NML has been at the same dividend for a while. The price has gone up. It's higher than our average buy-in price. But going forward, it is an MLP, and they invest in oil and gas as well as um, they invest in real estate, but not in your. It's like the renting out of real estate. They used to be invest. They used to be invested in like Crown Castle or AMT, which is a different type of toll bridge for data. So as these pipelines are toll bridges, like the Williams Company is a toll bridge of energy to where you have production and demand, and the Williams Company steps in and transports that. It's like a toll bridge. Crown Castle and AMT, American Tower, are similar in regards to data. They connect cell phone users to cell phone towers or cell phone companies and transmit data. It's an interesting little fund. Um, but on my end of things, yes, it's higher than our current average buy-in, and they haven't raised the dividend. The dividend's higher than it's been, but it's still not at 9%. So if we're going with discipline, then even though I can make an argument for those two funds, on my end of things, I have to look beyond those two funds. So that puts us with this list. So in culling out this list, the CLO market is still erratic. It's not that it's choppy, it is erratic right now. So as much as I like OXLC, and we still own it, ooh, I don't know if I can actually get rid of that. As much as I like OXLC, and we do still own it, it's not going to make my buy list anytime soon. I need more, or maybe I need less volatility in that one specific marketplace. So that eliminates a lot of the list. Um, Hicks doesn't really beat the market. River, um, River has a big BlackRock part. Um, EICS CLOs. I'm very with the current market and the amount of money coming into the U.S. I'm not looking to invest overseas, even in overseas bonds. Um, PDO remains on the hit list long term. Um, it's never, and it really never sells for a discount. It's always in premium. So you kind of have to catch it when it sits near or beats its 52-week rolling average. So it's close right now to that. I'm not an Aberdeen fan. Highland Global is largely invested in the midwave wireless. And the more I research midwave frequency, the more interesting it gets, but I still don't know enough. Although I do know that at $10 or almost $10, it's well above our average buy-in price. And the stock tends to cycle through. So if it dips down again close to eight, that's a buy for me. Um, Corporate bond fund, but we already own a lot of corporate bonds. I don't want to add another corporate bond fund just to pick up another corporate bond fund. It's got to bring me something different than what I already have. And DOY and PDO do that. So of this list, if I highlight, if I highlight, let's see, we've queried a lot of stuff out. If I highlight the stuff that remains, that's these funds. Now, of those funds, if I picked up DOY or PDO, I would want to pick up at least 100 shares of both. And I don't know if that's the best thing for me to do right now. I would honestly have to go back and dig into their pricing to see how this current price is. Like, yes, discount is important. And yes, the yield is important. And yes, they have brand name. Like Double Line and PIMCO are brand name, iconic funds, run extremely well. Um, and both would be great additions. But at the same time, I'm also well aware that 50% of my existing portfolio is tied to bonds. And despite my unconcern, like I'm not concerned about that di- division of such, I guess you could say. Um, but we're already like we're I don't know. I hate the term diversity because people just buy for diversity, but we're well diversified within the corporate bond world as it is. And even though both of those funds have been on my hit list, I really have to see if acquiring one of them would be a great idea right now. Of the existing list, there's three funds that make the most sense right now without me digging into PDO and DLY. One, BRW, two, FSCO, and three, Shakily USA. My hesitancy with buying USA is that I'm not going to see a dividend until January. And the cutoff date, the ex dividend date, normally sits mid November. So that's a long time to wait for a dividend. It's a great pickup right now because it's cheap and it's cheaper than our average buy-in price. And in the scheme of things, on their roller coaster, and it's not a roller coaster, but on their ebb and flow, it's on the lower end of things. So it's a great buy in that regard. But I'm not going to see a dividend as soon as I will with FSCO or BRW. BRW is offering rights. So BRW is invested into crypto. So their portfolio dragged a little bit when the crypto market dropped. They're also selling rights, which is also dragging down value too. Rights offering sits at 721, and there's a cutoff date for it. So I've been watching the cutoff date. I've been watching the price. Um, but that sounds like a decent deal for me. FSCO is lower than it's been. Maybe because they made a bad loan. I mean, they're a corporate bond fund, but they're really a business development company, and that's great for the coming market. It's great for the existing market. So, and it's lower, maybe because they seems like they made a bad loan and somebody they loaned money went into bankruptcy. but the descent really centered around when their last ex-dividend date or when their last dividend was paid. Like their dividend was paid, the price dropped, which is what happens. So it's 660 when their dividend gets paid, it drops by how much the dividend is. And then people panic for any number of reasons because it's like, oh my gosh, the price is going down. And then maybe they also made a bad loan, which it happened, except it happened to be a big loan. So then people panic more. And for whatever reason, it's still pretty darn cheap. So that seems like a good buy for me. And then USA, even though I'm not going to see a dividend for a while, still seems like a decent buy because it does do this. So if we're going to catch it lower and keep it short term, knowing it's going to come back up at some point, then yeah, it does seem like a good idea to pick up more shares of it. How much? I don't know. Depends on how much we have available. And long term, yes, PDO and DLY are on my hit list. Um, Price wise, they do ebb and flow. Dividends they pay. I want to say both are known to pay special dividends. In the grand scheme of things, in the overall grand scheme ebb and flow of things, if rates, if interest rates really do get cut and come down, bond prices should go up. So if we look at the overall cyclical wave pattern of that, if rates are coming down and will go down more and bond prices will go up, it makes sense to buy bonds. I'm also hesitant because it's almost like we're at the end of the cycle and you almost get that sense of like you're buying stuff on the fear of missing out. And on my end of things, I would have to look at the existing price of those funds related to their overall price. Not so much like discount, yes. Yield, yes. Monthly payers, yes. Special dividends are great. Brand name funds. DOY, we own DSL. DOY is completely different. Like it's separate, owned by the same, and structured differently. Like if it was DSL2, makes no sense. Like it makes no sense to buy a repeat fund, but it is set up differently. Uh, so it's tempting. I just don't know if it's as good of a deal as buying BRW, especially through the rights offering. I mean, for sure going to be cheaper. It's like half off compared to DOY and PDO. So if I can pick up another couple hundred shares of BRW, that's pretty good. Um, but on my end, I would really have to compare that pickup of additional shares of BRW compared to buying like 100 pack of PDO or DLY. So on my end of things, outside of those two funds, the best move for me is buying more shares of BRW just based on price. FSCO, same thing. USA, same thing. I can't answer for the other two right now. But my point is, I can explain what's best for me. You have to figure out what's best for you. And that's why I'm not sifting out like I'm not cutting things off the list at this point. You should go through this list and see what offers you the best deal overall in relation to what you already have in your portfolio. And if you have none of it in your portfolio, well, you get to figure out what's the best thing for you in the existing market, like what's the best deal you can scoop right now that sets you up going forward. If some of this is in your portfolio, then you're trying to figure out it's the same thing just based on what you already have. And the choice is yours. I mean, my goal has been to supply information. It's never been to take your money and buy the stuff for you. My goal is information and encouraging you and helping you become your own portfolio manager. It's pretty darn rewarding. Um, and I really do enjoy it. So I don't know if I would have said the same thing 10 years ago, but having taken on the responsibility, I really do enjoy it. Um, yeah, and even supplying access to the list, my goal would be to offer the list and not like I don't want to be your broker. I don't want to be your I don't want to be your financial advisor. Like I don't that's not my it's not my goal, not my purpose. My goal is to explain my strategy and why. My goal is to share information. My goal is to encourage you and help you build wealth and know there's a better way to do it than the traditional buy single stocks and hope for growth. The dividend world and the closed-end fund world is so much better than the traditional advice. So see what you think, sift the list, and then make. So here's part of it. There's the other part. Pause your video and make the best decision for you. Uh, that's really the best advice I can give you. Make the best decision for you. So if this has been helpful for you, if this has been informative for you, please consider liking my video, subscribing to it, and then sharing it with somebody else. And whatever you have for the week, uh, whatever you have for the week, I hope it goes well. I wish you success, and I will see you back on another video. So have a great evening, everybody. See you later. Bye bye.